In 1987, the organization that ensured the savings of ordinary Americans ran out of money. Not a bank, not a company. The insurance fund itself, the Federal Savings and Loan Insurance Corporation, the body whose entire purpose was to guarantee that if your savings institution failed, your deposits were safe. Its accounts, when they were finally examined honestly, showed that it was insolvent. It could not cover the losses already sitting in front of it, let alone the ones still coming. The fund that existed to make people whole had itself gone bust. There was no announcement, no emergency broadcast, no queue outside a branch. It simply became true and was recorded, and for another 2 years very little was done about it. What followed was the largest financial cleanup the United States had ever undertaken up to that point. Roughly 1,000 savings institutions were closed or forcibly merged. A government corporation was created for the sole purpose of seizing them, taking their assets, and selling the wreckage. The final bill to the American taxpayer came to something on the order of $124 billion in the money of the day. And here is what makes this worth 35 minutes of your time. It was not caused by a crash. There was no panic, no run on the banks, no single day when everything fell over. There was no fraud clever enough to explain a number that size, though there was plenty of fraud. It was caused by a series of decisions that were, at the time they were taken, popular. Each one was defended in Congress with reasonable arguments. Several passed with overwhelming bipartisan majorities. The people who made them were not fools and mostly were not crooks. This is the story of how you destroy an entire industry by trying to save it. To understand what went wrong, you have to understand what a savings and loan actually was, because it was not a bank in the sense you are thinking of. They were called thrifts or building and loans, and their business was almost embarrassingly simple. They took deposits from local people. They lent that money out as long-term fixed-rate mortgages to other local people, so those people could buy houses. That was the whole enterprise. They did not trade. They did not underwrite. They did not have an investment arm. A thrift in a town of 20,000 existed to turn that town's savings into that town's houses. If you have seen It's a Wonderful Life, you have seen one. The Bailey Building and Loan is not a bank in that film, and the script is careful about the distinction. When the crowd arrives wanting their money, George Bailey tells them it is not sitting in a safe. It is in Joe's house and in 100 other houses around the town. That is an accurate description of the business model, and it is also an accurate description of why the model is fragile. The money is real, but it is not available. The industry described its own working day as 363. Borrow at 3%, lend at 6%, and be on the golf course by 3 o'clock. It was a joke told by the people who worked there, and it was accurate. The business was not intellectually demanding. It was designed not to be. This was deliberate. After the collapses of the early 1930s, American financial regulation was rebuilt around the principle of separation. Institutions were confined to particular activities and prevented from wandering. Thrifts got housing. In exchange for accepting that box, they got two things: federal deposit insurance, so savers had no reason to run, and a rule called Regulation Q, which capped the interest that could be paid on deposits, but allowed thrifts to pay 0.25% more than commercial banks. That quarter point was the industry's whole competitive position. It was enough. If you wanted a savings account, the thrift on the high street paid slightly more than the bank, and there was nowhere else to go. The arrangement worked for roughly 40 years, and it worked because of one assumption so deeply embedded that nobody thought to examine it: that interest rates would stay low and stable. Every thrift balance sheet in America was a bet on that assumption. Look at the structure. On one side, deposits money that can be withdrawn at any time, repriced constantly, short. On the other, 30-year fixed-rate mortgages, money locked away at a rate agreed in 1968 and not adjustable until 1998, long. Borrowing short and lending long is the oldest trick in banking, and it is genuinely useful because it is how a society converts savings into houses. But it carries one specific risk, and the risk is not that borrowers default. It is that the cost of your deposits rises above the yield on your loans and stays there. If that happens, you do not have a bad quarter. You have an institution whose income is permanently below its costs, holding assets it cannot sell without crystallizing the loss. In the 1970s, that is precisely what happened. Inflation arrived and would not leave. By the end of the decade, American consumer prices were rising at double-digit rates. In 1979, Paul Volcker took over the Federal Reserve and did the necessary and brutal thing. He raised interest rates until inflation broke. The federal funds rate went above 19%. Now put that against a thrift's balance sheet. Its mortgage book is earning 6, 7, 8%, rates fixed years earlier and locked in for decades. To hold on to deposits, it would need to pay depositors something in the region of 12 or 15. It could not. Regulation Q forbade it. The cap that had protected thrifts for 40 years now trapped them, because they were legally prevented from paying a competitive rate. And by then, for the first time, savers had somewhere else to go. The money market mutual fund had appeared in the 1970s and grew explosively in exactly these conditions. It was a simple product. Pool depositors' money, buy short-term government and corporate paper, pass the yield back. It was not insured, but it paid the market rate, and when the market rate is 15% and your thrift is legally capped at 5.5%, insurance stops feeling like the deciding factor. Money left. It left in enormous quantities. The industry called it disintermediation, which is a bloodless word for savers walking out of the door. By 1980, on any honest accounting, a large part of the American thrift industry was already insolvent. Not heading for trouble, insolvent. The mortgages on their books, valued at what anyone would actually pay for a stream of 6% income in a 15% world, were worth far less than the deposits owed against them. Estimates at the time put the industry's true net worth at a negative number, in the region of $100 billion. The crisis, in other words, had already happened. What remained was the question of what to do about it. And that is where the decisions were made that turned a $100 billion hole into something far worse. There were broadly three options. The first was to close them. Recognize that several thousand institutions were insolvent, wind them up in an orderly fashion, pay out the insured depositors, and take the loss. It would have been enormously expensive and politically radioactive. Thousands of institutions, in every congressional district in the country, employing people and financing houses. The second was to fund them. Except that the government had effectively created this exposure through Regulation Q, appropriate the money, and recapitalize the industry. Also enormously expensive, and it required Congress to vote publicly for a very large number at a moment when the political mood was firmly against spending. The third was to change the rules so the problem did not have to be recognized, and let the industry try to earn its way out. Congress chose the third. It always does, and it is worth understanding why rather than simply condemning it. The first two options require somebody to stand up and name a loss now. The third defers everything, costs nothing today, and can be described in the language of freedom and modernization. Given those incentives, the third option is not a temptation. It is close to inevitable. It arrived in two acts, and they are worth taking separately. The first was the Depository Institutions Deregulation and Monetary Control Act of 1980. It began phasing out Regulation Q, which was defensible. The cap was strangling the institutions it had been built to protect. But it also did something else, quietly, which almost nobody objected to at the time. It raised the federal deposit insurance limit from $40,000 to $100,000. That change sounds like consumer protection and was sold as consumer protection. In practice, it was the most consequential single provision in the entire story. And to see why you have to think about who benefits from insurance on a $100,000 deposit. It is not the ordinary saver. In 1980, the median American household did not have $40,000 in a savings account, let alone 100. Almost every genuine retail depositor in the country was already fully covered at the old limit. What the increase created was a completely safe, fully guaranteed $100,000 unit of money, and a market immediately grew up to move those units around. Deposit brokers would take large sums from institutional clients, slice them into $100,000 parcels, and place each parcel with whichever thrift in America was paying the highest rate that week. The deposits were insured, so the broker did not care in the slightest whether the institution was sound. Only the rate mattered. This meant that a thrift, anywhere in the country, could now raise effectively unlimited money simply by offering the best rate. Its reputation was irrelevant. Its solvency was irrelevant. Its management was irrelevant. The federal guarantee had severed the connection between how risky an institution was and what it had to pay to borrow. Hold that thought, because on its own it was survivable. What made it lethal was the second act. The German Depository Institutions Act of 1982 removed the box. Thrifts, which for half a century had been confined to residential mortgages, were now permitted to put substantial portions of their assets into commercial real estate, into land development, into commercial lending, into service corporations and direct equity investments in projects. Several states, competing to attract charters, went further still with their own institutions. Texas and California most notably, where a state-chartered thrift could invest in more or less anything. President Reagan, signing it, called it the first step in a comprehensive program of financial deregulation, and said he thought they had hit the jackpot. It passed with broad bipartisan support. It was not a partisan crime, it was a consensus. Now assemble the pieces, because the combination is the whole disaster in one sentence. An industry that was already insolvent, whose managers therefore had almost nothing left to lose, was given the ability to raise unlimited federally guaranteed money at will, and simultaneously permitted to invest that money in speculative commercial property development, while remaining subject to net worth requirements that had been lowered and to accounting rules that let losses be hidden. Every element of that sentence was a reasonable-sounding reform. Together they constitute the most dangerous structure it is possible to build in finance, and it has a name. Economists call it gambling for resurrection. Consider the position of a thrift executive in 1983, whose institution is technically worth less than nothing. The equity is gone. If the business continues as it is, the regulators will eventually arrive and it will be closed. He will lose his job either way. Now he is offered a proposition: take federally insured deposits and put them into speculative land development. If the development succeeds, the profits restore the institution. He keeps his job and he is a hero. If it fails, the institution is closed, which was going to happen anyway, and the losses fall on the insurance fund. Heads, he wins. Tails, the taxpayer loses. that is not a temptation to bad character. It is the rational response to the incentives as they were constructed, and it is what an enormous number of institutions proceeded to do. The money went where the story was best, and in the early 1980s the story was Texas. Oil had boomed, the Southwest was growing, and thrifts poured money into commercial property development across Texas, Arizona, Colorado, and California. Office towers, shopping centers, vast condominium projects. Raw land bought on the expectation that it would be worth more next year. Some of it was ordinary bad lending, too much money chasing the same square mile. But a significant portion was outright fraud, and the mechanism was almost always the same. It was called a land flip. Take a parcel of land worth, say, $1 million. Sell it to an associate for $2 million, financed by a loan from your thrift. Your associate sells it to another associate for $4 million, again financed by your thrift. That party sells it back into the circle for $8 million. Each transaction is real in the sense that documents were signed and money moved. Each one establishes a new and higher recorded sale price, and appraisers, often selected and paid by the people doing the flipping, would value the next transaction against the last. At the end, you have a piece of land worth $1 million carried on the books at $8 million, several loans that will never be repaid, and a set of participants who have each taken fees and profits in cash along the way. The money is gone into private hands. The loss sits with the institution, which means it sits with the insurance fund, which means it sits with the public. At Empire Savings of Mesquite, Texas, this was carried out along a stretch of highway east of Dallas on a scale that became notorious. Condominium projects financed into existence with almost no genuine demand behind them, some of them never finished, standing empty in the Texas sun. Empire was seized in 1984. The regulator who examined it described a pattern of land flips and inflated appraisals that had generated enormous paper values out of nothing. And when the oil price collapsed in the mid-1980s, the Southwest's economy went with it. The offices did not fill, the condominiums did not sell. The land was worth what it had been worth all along. There was a second destination for the money, and it connects this story to the other great financial scandal of the decade. Garn St. Germain and the state charters had permitted thrifts to hold corporate debt, and the corporate debt on offer in the 1980s was high-yield, junk bonds, the market built and dominated by Michael Milken at Drexel Burnham Lambert. For a thrift management gambling for resurrection, junk was close to ideal. It paid far more than a mortgage. It could be bought in size, instantly, without originating anything or employing anyone. And it could be funded with brokered deposits raised the same week. Some institutions went in very heavily. Columbia Savings and Loan of Beverly Hills, run by Thomas Spiegel, built a junk bond portfolio in the billions, an institution nominally in the business of housing finance holding a corporate debt book that would have been substantial for a Wall Street firm. Lincoln held junk too, among a great deal else. This produced a circularity that is worth being precise about. Thrifts bought junk bonds. Some of those bonds financed takeovers and property ventures. Drexel had strong relationships with several of the thrifts buying the paper. When a market is substantially composed of a small number of participants who know each other, the prices in it are not independent evidence of anything, and thrift balance sheets were being valued against exactly those prices. When the junk market seized up at the end of the decade, and when Drexel itself collapsed in 1990, those portfolios fell hard. FIRREA then required thrifts to divest their junk holdings, forcing sales into a market with almost no buyers, which drove prices lower still and deepened the losses on the way out. It is a small illustration of a general rule. If you permit an institution to buy an asset, you have also made yourself dependent on that asset's market staying liquid. And the moment you force 1,000 institutions to sell the same thing at the same time, it will not be. Which brings us to the part of the story that is hardest to defend: what the supervisors did while this was happening. They were, first of all, overwhelmed by design. The Federal Home Loan Bank Board supervised the industry, and as thrifts moved into commercial property and complex investments, the job of examining them became vastly harder, while examiner numbers and budgets did not rise remotely in proportion. Deregulating an industry's activities while holding its supervision flat is a decision, even when nobody makes it explicitly. Second, they had been handed accounting rules that permitted institutions to look healthy when they were not. Under regulatory accounting principles, thrifts could count things towards their net worth that no ordinary company could, and could spread losses forward over long periods rather than recognizing them. When an institution merged with a failing one, it could book the difference as goodwill and amortize it over decades, creating, out of an acquisition of something worthless, an asset that counted as capital. Third, and most seriously, when the head of the bank board, Edwin Gray, concluded around 1984 that the direct investment powers were producing catastrophic risk and moved to restrict them, he was resisted by the industry, which lobbied hard, and by members of Congress who intervened on behalf of institutions in their states. The clearest illustration is Lincoln Savings and Loan of Irvine, California, and its owner Charles Keating. Keating had bought Lincoln in 1984 through his company, American Continental Corporation. Under his ownership, it moved sharply away from mortgages and into land, hotel development, currency trading, and junk bonds. Examiners from the San Francisco Bank Board office concluded that it was operating dangerously and recommended action. Keating fought back on every front available. He hired economists to argue his case, including, at one point, a consultant named Alan Greenspan, then in private practice, who wrote in support of Lincoln's direct investments and of its management. He litigated, he lobbied. And in 1987, 5 United States senators who had received substantial contributions connected to him met with regulators to ask about the examination of his institution. Those 5 became known as the Keating 5. The Senate Ethics Committee later examined their conduct and reached varying conclusions about each. One was formally reprimanded for improper conduct, and others were criticized in different degrees while being cleared of acting corruptly. Whatever the individual findings, the collective effect is not in dispute. The examination was delayed. Lincoln stayed open for a further 2 years. And when it was finally seized in 1989, it produced one of the single largest losses of the entire crisis, well over $2 billion. There is a further detail that deserves stating plainly. American Continental had sold its own subordinated bonds to members of the public through Lincoln's branches. Roughly 23,000 people, many of them elderly, bought paper they appear to have believed was as safe as a deposit. It was not insured. When the company failed, the bonds were worthless, and something in the region of $250 million of ordinary people's savings went with them. Keating was prosecuted, convicted in both state and federal proceedings, and served time in prison, though those convictions were later overturned on appeal, and the matter concluded with a plea agreement covering time already served. Before we get to the cleanup, there is a stretch between 1986 and 1989 that deserves attention, because it is where the bill roughly doubled. By 1986, the FSLIC's own position was understood inside government. The fund did not have the reserves to close the institutions that were already gone. and this produced a peculiar and expensive form of paralysis. The insurer could not afford to do its job. Closing a thrift means paying out its insured depositors, and that requires cash the FSLIC did not have. So institutions everyone knew were dead were left open, not through corruption, but because shutting them was unaffordable. Congress was asked to recapitalize the fund. The bank board's assessment was that something around $15 billion was needed, and even that was arguably light. The industry's trade body lobbied hard against a large figure, on the reasonable-sounding grounds that a big number would frighten depositors, and that healthy institutions should not pay for the failures of the reckless. What emerged in 1987 was a recapitalization of about $10.8 billion, drawn out over time. It was not enough. It was not close to enough. And it arrived with language encouraging supervisors to show forbearance toward institutions in difficulty rather than closing them. Then came a presidential election year, and 1988 passed without serious action. Meanwhile, the bank board did what it could with the money it had, and what it could do was arrange deals, hand failing thrifts to acquirers, sweetened with tax benefits and federal guarantees against future losses on the assets acquired. More than 200 such transactions were done in 1988 alone, many of them concentrated in the final weeks of December. Some of those deals were later judged to have been extraordinarily generous to the buyers, because the government was negotiating from a position of having no cash and no time. So for 3 years the machine ran in the worst possible configuration. Everybody knew the institutions were insolvent. Nobody could afford to close them. And every month they stayed open, they took on more federally guaranteed deposits and put them into worse assets. That is where the money went, not into the fraud, spectacular as some of it was, into the interval between knowing and acting. By 1989, the position was no longer deniable, and the government did what it should have done in 1981. The Financial Institutions Reform, Recovery and Enforcement Act became law in August 1989. It abolished the Federal Home Loan Bank Board and the insolvent FSLIC. It moved thrift deposit insurance to the FDIC. It raised capital requirements and removed much of what Garn St. Germain had granted. And it created the Resolution Trust Corporation, a government body with one job: to take over failed thrifts, seize their assets and sell them. The Resolution Trust Corporation became, for a period, one of the largest owners of real estate on earth. It held office buildings, shopping centers, undeveloped land, half-finished condominium blocks, hotels, and a long tail of oddities that had somehow ended up as thrift assets. It sold them, often at a fraction of their recorded value, over the following 6 years. The final accounting, roughly 1,043 savings institutions, out of an industry of a little over 3,000, failed or were resolved between 1986 and 1995. The total cost has been estimated at around $160 billion, of which approximately $124 billion fell on the public. There were prosecutions, and more than is usually remembered. Well over 800 people were convicted of crimes connected to the thrifts, including a substantial number of chief executives and directors, with many receiving prison sentences. Whatever else can be said about the American response to this crisis, individuals were tried and jailed on a scale that has not been matched since. It is worth pausing on who actually paid, because the taxpayer is a phrase that hides more than it reveals. The direct cost was met by federal borrowing, which is to say by everyone, spread thin and over decades. That is the visible number. But the concentrated damage fell in particular places on particular people, and it did not show up in the headline figure at all. The Southwest took the worst of it. When a region's construction industry has been financed into a boom that was never supported by real demand, the correction is not an abstraction. Half-built developments stopped. Contractors who had done the work were not paid. The property market in parts of Texas took years to recover, and households who had bought at the top were left holding assets worth a fraction of their mortgages. The thrift failures did not cause the oil bust, but they had amplified the boom that preceded it, and the amplification worked in both directions. Employees of the institutions lost their jobs on a scale the industry had never seen. A whole professional class of local savings and loan managers, tellers and clerks, in towns where the thrift had been a fixture for generations. And then there were people like the Lincoln bondholders, individuals who had walked into a branch, been sold a piece of paper by someone they took to be their bank, and discovered afterwards that the guarantee they assumed was there had never applied to it. There is a version of the story where the villains are a handful of memorable crooks, and it is a satisfying version. It is also misleading, because the great majority of the loss was not stolen. It was lost by institutions that were already insolvent, taking rational gambles under rules that made gambling the only available strategy, using money the government had promised to repay. So what should be taken from it? Not that deregulation is inherently wrong. That is too easy, and it is not what the evidence shows. Regulation Q was genuinely strangling the industry, and removing it was correct. The lesson is narrower and much more useful. The catastrophic element was not deregulation on its own. It was deregulating the asset side while guaranteeing the liability side. Thrifts were freed to take risks with money the government had promised to repay. Every one of those risks had an owner on the way up and no owner on the way down. You can let institutions take risks, and you can guarantee their funding. What you cannot do is both at once, because that removes the only force that reliably restrains risk-taking, which is the fear of the people whose money is at stake. Deposit insurance deliberately removes that fear. That is its purpose, and it is why bank runs largely stopped. But it means the discipline has to come from somewhere else, and the only remaining candidate is supervision. Which is why the second lesson matters as much as the first. Supervision has to scale with the complexity of what is being supervised. The examiner corps that could adequately check a thrift making 30-year mortgages in one town was hopelessly inadequate for one financing speculative development across 3 states. Nobody decided to undersupervise. They simply expanded what was permitted without expanding the capacity to watch it. And a last one, which is the most uncomfortable. The crisis was fully visible in 1980. The industry's insolvency was known, quantified, and discussed openly in official documents. Every year that passed without recognizing it made the eventual bill larger, because the institutions kept trading, and an insolvent institution allowed to keep trading does not stand still. It gambles, because gambling is the only strategy that can possibly save it. The $124 billion was not the cost of the problem. It was the cost of the delay. 18 years later, a great deal of that would be tested again. The parallels to 2008 are real, but they are not the ones usually drawn, so it is worth being exact. The instruments were different, mortgage-backed securities and credit derivatives, rather than land flips and junk bonds. The institutions were different and vastly larger. What repeated was the structure underneath. In both cases, a set of firms was able to take risk with money that somebody else had guaranteed. In the thrifts it was explicit, federal deposit insurance written into law. In 2008, it was implicit, the widely held and ultimately correct expectation that certain institutions were too important to be allowed to fail. Explicit or implicit, the effect on behavior is identical, Because what matters is not the paperwork, but whether the people supplying the funding believe they can lose it. In both cases, supervision had not kept pace with what it was supervising. In both cases, losses were recognized late, and the delay was expensive. And in both cases, when the position finally became undeniable, the public balance sheet absorbed it. The differences are instructive too, and not all of them favor the modern response. The thrift crisis produced over 800 criminal convictions, including senior executives. The 2008 crisis produced almost none. Whatever conclusion you draw from that, it is not that the earlier generation of regulators was more timid. And there is one lesson from 1980 that has never really been absorbed, because it is the least comfortable of all. The most expensive thing a financial system can do is not fraud, and it is not even bad lending. It is allowing an institution that everybody knows is insolvent to remain open, funded, and free to place bets. Every incentive in politics runs toward that outcome, because closing it costs money today and leaving it open costs money later, on somebody else's watch. 1,000 institutions and $124 billion is what that arithmetic costs when it runs for 9 years without interruption.